Is ethical insurance better or just different? Hi, I'm Scott Harris. Welcome to the Insider. Today, I want to talk about a question most people never ask. Is there such a thing as ethical insurance? And if there is it actually better? Most people think insurance works one way. You pay a company, the company accepts the risk, then, if something goes wrong, you file a claim and hope they pay what they owe. That is the model most of us know. That is the model we live under. And that is the model most policyholders are stuck trying to understand only after something has already gone wrong, which is always convenient for the insurance company. But there is another model most people in the United States have never really looked at. It is called Takaful. Takaful is often described as Sharia-compliant insurance. But whether you are religious, secular, Muslim, Christian, Jewish, or just someone tired of reading policy language written like a hostage note from a law firm, the structure itself is worth understanding. Because Takaful flips the traditional insurance model. In traditional insurance, you transfer risk to a company. You pay premium. They take on the contractual obligation. They collect the money, they manage the risk, they invest the reserves, and if things go well, the company profits. That profit belongs to the company and its shareholders. In Takaful, the concept is different. Instead of transferring risk to a company, participants share risk with each other. Everyone contributes into a fund. That fund exists to help pay covered losses for the members of the group. The company does not own the risk in the same way. The company manages the fund. That may sound like a small difference. It is not. It changes the entire philosophy behind the system. Traditional insurance is built around risk transfer. Takaful is built around risk sharing. Traditional insurance is often profit-driven. Takaful is designed around cooperation, mutual responsibility, and ethical limits on how funds are handled. Supporters argue that makes it better. And on paper, they have a point. In a Takaful model, surplus funds may be returned to participants instead of simply becoming shareholder profit. Investments are supposed to stay within ethical boundaries. That means avoiding industries like alcohol, gambling, and other prohibited or questionable sectors. Fees and management structures are usually intended to be more transparent. And the whole model is built around the idea that participants are helping each other, not simply feeding a corporate machine. On paper, it sounds like how people wish insurance worked. A shared fund, transparent structure, ethical investment, mutual protection, less shareholder-first thinking. No corporate fog machine telling you your claim is still under review, while everyone pretends the calendar does not exist. But here is where reality walks into the room and ruins the brochure. Takaful is not magic. It still has limitations. Smaller risk pools can mean higher costs. Limited availability can make it hard to access, especially in the United States. The structure can be more complicated, and depending on how the pool is funded, payouts are still limited by the money available. That matters, because at the end of the day, every insurance system has to answer the same basic question. Who pays when something goes wrong? That is the entire game. The roof fails, the house burns, the pipe breaks, the business gets interrupted. The loss happens. Somebody has to pay. Traditional insurance answers that question one way. It says, the company accepts the risk in exchange for premium, subject to the policy. Takaful answers it another way. It says, the group shares the risk, and the fund exists to protect the participants. Neither system escapes the laws of math. Neither system escapes claim pressure. Neither system escapes human behavior. And neither system becomes perfect just because it uses better language. That is the part people need to understand. A more ethical structure does not automatically mean a perfect outcome. A cooperative system can still have disputes. A shared risk model can still face funding problems. A transparent structure can still become complicated. And traditional insurance, for all its flaws, does offer scale, efficiency, capital strength, and massive risk-spreading capacity. So, what is the truth? Is Takaful better? Is traditional insurance better? The honest answer is it depends on what you value. Traditional insurance prioritizes efficiency, scale, capital strength, and profitability. Takaful prioritizes shared risk, ethical boundaries, mutual responsibility, and cooperation. Both are trying to solve the same problem. Who pays when something goes wrong? They just answer that question differently, and that is the point. Insurance is not a fixed system handed down from the heavens. It is a design choice. The structure matters. The incentives matter. The money flow matters. Who controls the fund matters. Who benefits from surplus matters. Who makes claim decisions matters. And who gets protected first matters most of all. Because every insurance model protects you, but it also protects itself. Traditional insurance protects the company's capital, underwriting model, reserves, shareholders, and balance sheet. Takaful protects the shared fund, the participants, the ethical framework, and the sustainability of the pool. Different philosophy, same pressure. Different structure, same question. Who pays when something goes wrong? That is why this conversation matters. Because once you understand how insurance is designed, you stop looking at it like a bill. You start looking at it like a system. And once you understand the system, you can ask better questions. Who owns the money? Who controls the claim decision? Who benefits if claims are lower? Who benefits if surplus remains? Who absorbs the loss? Who carries the risk? And who gets protected when the system is under pressure? That is where the truth usually lives. Not in the marketing, not in the slogan, not in the polished brochure. The truth is in the structure. So, is ethical insurance better? Maybe, maybe not. But it is absolutely different. And understanding the difference helps expose something much bigger. Insurance is not just about protection. It is about power. It is about control. It is about incentives. It is about who holds the money before the loss, who releases it after the loss, and who gets to decide what covered means when the bill finally comes due. Bottom line, every insurance model claims to protect you, but every insurance model also protects itself first. The only difference is how honest the structure is about it. I'm Scott Harris. This is The Insider. And no, insurance is not boring. People just explain it that way, so you stop asking questions.